trading models and people trying to. Thanks, Lizzie. Lizzie only told me to record 3 times, I think, and I still didn't do it. Good job. So, you're seeing a lot of movements that are often just people trying to clip profits really quickly. And that explains a lot of what's going on intraday or out of no place. But, there's a lot of words that are thrown around. So, my version of a bear market, the real definition they say is 20%. I think we're pretty close to that. We're 3,900 on the S&P, and I think we're 18, 19% down year to date. The NASDAQ is definitely 28%. Who cares about the Dow? But really, what I think of as a bear market is stocks are going back to their rightful owners. If you have a great cash generation machine, like say Apple or Microsoft, and you value a stock or you value a company really based on cash flows, and then discount those cash flows over a period of time. If Microsoft is at 330 6 months ago or 4 months ago, and it's at 250 yesterday, somebody bought it at 250. Now, that person bought it because they have a longer term time horizon than the person who sold it. So that's all a bear market is. And it's about cash flow, and it's about sales, and it's about profitability. So, think about the words that you use. And I think it'll be somewhat comforting if you can sort of put that perspective on it. Okay, so today's agenda, number one, if anybody has ever taken yoga, you walk in there and they say, set your intention for the day. So that's my one yoga lesson. Maybe I'll say, we'll go into Shavasana at the end while I go to sleep. But I want everybody to take something away from today. Set your intention about what your takeaway is, what you want to learn, what you'd like to feel better about. What I'm going to talk about is some of the emotions that we're all feeling. I want to review risk versus volatility, timing the market, the old questions that everybody wants to know about. I'm going to discuss our investment policy, how we make decisions and how we run the money and how we handle the investments. I want everybody to have some peace of mind with their plan. I'm going to talk about, once again, what your plan really means and how we think about your plan. And we're going to talk about the models and how you're situated and how they're performing. And happy to address questions after that. All right, so we are all, and I'm saying I'm part of this. I don't like feeling that the world is upside down. Sometimes you get up and you read the news and it's like, where does it all end? War, pandemic, hyper-political, election cycles, 100 different things going on at one time. And I'd like to point out that the healthy way to handle that when it comes to your investments is you own them and embrace them. Try to lean into them. I hate to use that old adage, that I think Eleanor Roosevelt said, you do something every day that you're afraid of, but embrace that volatility and lean into it. Just try to resist acting on them. You have that thing in your head, the amygdala, that's your fight or flight that made you run away from, lions way back in the day. And it's trying to protect you. So that's what we're here for. We're here anytime. You call or text or email and we'll get on the phone with you. Now, if you look at stocks and what they're going to do for you over the long term, they're going to earn you money. And what I will say is that virtually every mistake that you'll see in the market is rooted in people looking at the market and their market returns and saying to themselves, you know what, that's really nice, but I'd like to have that return now. And the market moves on its own terms, not yours. And, once again, what you're seeing is upsetting. And it's this impulse we have to act. What should we do? Should we sell? Should we curl up in a ball? We want to feel in control. And that's the fallacy. You can't really be in control of what's going on in the market. You can be in control of your inputs, how you invest and allocate. So real quickly, there's basically no chance that a quality investment is going to zero. And I repeat, a quality investment is not going to zero. We're not going to have this conversation today about the world ending, but the world will only end once. If you want to have that conversation with me and we're going to talk about, taking gold down the street and buying bread from somebody, that's fine too. But today what we're going to talk about is the reality of the markets and essentially what the difference is between true risk and volatility. And what I'm here to tell you today is that with respect to volatility, that's all it is. It's movement up and down. And a lot of you have heard me use this example of the virtual reality goggles, but let's just talk about what risk really is. Time horizon is a risk, meaning you have $100,000 and you want to invest it, but your child is going to go to college in a year, or you have a house to buy, or there's some purchase or something you need to use that money for, but you want to invest in the market and you have a year time horizon, and you got to pull it out. And of course, market's going to be down. Statistically, in a year period, it's a 50-50 shot the market will be down. You got to pull it out, and the 100 turned into 90. You've lost capital forever. It's gone. It'll never make interest. It'll never make dividends. It'll never grow again. That's risk. So number one, you need to understand your time horizon. Every one of you on this call who are clients of mine, we have that call, that talk constantly. And you hear me say constantly, do you have the cash reserves that you want? If you need money, here it is. And we have that conversation because what I don't want to do is risk capital. And then, of course, inflation. Inflation is risk. The only real sane definition of money is purchasing power, where your money will stay ahead of the increasing costs of goods and services. Now, I'm not talking about year-over-year inflation. I'm talking about long-term inflation. If you have $1 today and inflation is 3%, that dollar is going to be worth 50 cents in 23, 24 years. That's risk. And you have to be mindful of that. So when we talk about investing and it's cash versus bonds versus stock, and we want that asset pool to grow because all of you are going to live long, healthy lives, we have to keep up with inflation. Everything else is volatility. And by the way, I'm not talking about a get-rich-quick type of penny stock. Yes, that can go to zero. But once again, the operative word is quality. And by the way, if any of this is concerning to you or you have a question about it, keep a note, ask me either now in the conference or come back to me. So some of you have heard the saying that the market always climbs that wall of worry. There's always something to worry about, and it's a grave concern. As the saying goes, and I said it before, actually, it's not the saying, I'm sorry. This time is never different. You have pandemics, election cycles, external threats. Some of you have been around for longer than others. That it was interesting. I was looking at the dispersion of age in my practice, and the middle of the bell curve is about 58 years old. But that means on the right side, there's a lot of people that are older than 58. But I've had a lot of younger people come in, and some of you have seen many, many, many scary things. And every decade's got something. And those of you who are in your late 60s, 70s, even 80s, your parents went through the Depression and World War II. You've seen and heard a lot. And to some degree, I know some of you are even traumatized by this. In the 30s, the 30s and 40s, the Germans are coming. And, the Japanese are coming. And then the Russians are coming. And some of you, maybe the Redcoats were coming. I don't know. But there's always going to be something. And what I'm here to talk about today is this perspective that we need to keep, because when things are bad, that's the time when you have to have that perspective, that historical and also prospective go forward calmness and feeling that it's all going to be okay, but you have to know why. So I wanted to give you some real perspective historically. So since 1928, there's been some pretty bad stuff. Numerous wars, recessions, so on and so on, depression, any number of things. So 90 times the market has dropped at least 10%. That's once about every year or so. Now, every year or so, the market drops at least 14%. Every 4 or 5 years, it's down 30%. So the last time that happened, as we all know, for most of us, I think, was a couple of years ago in March of 20 during the pandemic. We were down 32%. We had a pretty good run before that. The big drop before that was in 2009. The S&P was down 57% during the global financial crisis. Now, from 1982, and I'm using 1982 because everybody, the topic du jour is inflation, right? Everybody's been talking about we're at a 40-year high of inflation, and that's correct. So I'm using 1982 because the last time inflation was really high was back then, and I believe it was about 6.4% that year. The number that we use to measure inflation is called the Consumer Price Index, the CPI. And the index, the Consumer Price Index at that point in time, was 96. Now, last week, the print came out, the CPI print, and it was 281. So the year-over-year inflation was horrific. It was 8%. And if any of you, and I suspect most of you, go to the grocery store, it's troubling. And of course, food costs are higher. So if you go out to eat, it's even worse. And you're seeing it at the gas pumps and everywhere. You try to rent a house or buy a house. So it's everywhere. But the point I wanted to make in this third bullet is that if you take a trend line from 1982 to 2022, it's 2.78% a year. And the takeaway from this is that your perspective needs to be longer duration. You know, you have a line that goes like this, you stretch it out a little bit like silly putty, it's going to become not 8%, it's becoming 2.78%. And the Federal Reserve mandate is low inflation and high employment or low unemployment. This will revert to the mean. I mean, I don't teach economics, and I don't pretend to be able to teach Econ 101, microeconomics. But what I can say is that very much of what's going on with inflation right now. And by the way, those of you who remember, a year and a half ago, I was on this forum and I said I felt that inflation was transitory. It's fleeting. It's not fleeting. It's still here. But I believe then and I believe now it wasn't true inflation that is demand driven. It's supply driven. And if you think about what happened during the pandemic, you have 50 years of managers who went to Harvard for their MBAs and so on and so forth and learned how to do business. And the way they manage the supply chain is just in time. So, of course, you have this pandemic. It blows up the entire supply chain. And then you have China persistently shutting down, which is where a lot of the supply comes from. And then, of course, you have this war, which is driving up commodity prices. And you could see the problem. But ultimately, what's going to happen, even if there's a recession, ultimately this will revert to the mean. So, once again, if anybody wants to push back on me, that's fine with me. I just wanted to address that number because yes, 8 is bad, but 2.78 is about trend line. So you're talking to me about inflation and how do you handle inflation? What are you supposed to do about it? And this is a very, very important concept. We talk about how to invest and how do you solve the problem? Can't be in cash. What do you do? So 1961 CPI is at 30. Consumer Price Index is at 30, and the earnings on the S&P 500 is $2.04. That is one share of the S&P, which back then was about $60 or 60. Now it's like 4,000. The earnings on that, if you think about it like a dividend, were $2.04. 2022, jump ahead, 51 years, you have a CPI of 281 and earnings on the S&P of 206. All that means is that the S&P earnings, that's the basis on which stocks go up in price, was up 100 times. Inflation was up 9 times. So, Lizzie, there's somebody in the waiting room. So I ask you, how do you solve your problem? You have to buy an asset that's growing in value, or certainly work and make more money. But this is a little more sustainable and long term. And then finally, just in terms of the march upwards in equity values, in May of 22, as of yesterday, and that terrible drop, the S&P 500 is at 3,900. So from 1961 till 2022, S&P went up 64 times. From 1982 till 2022, went up 37 times. From 2009 until 2022, went up 4 times. If you took $100,000 and you invested it in 1992, don't ask me why I didn't use 1982. I'm not really sure why. It's $875,000. That's with dividends reinvested. And then finally, 340 if you took it and put it to work in 2000 and let's see, 2002. So that's today's lesson in perspective. Now, we're talking about going to cash. I don't want to spend too much time on this. I just want to point out that there's been a lot of studies done on this. And in almost no circumstance can you effectively time the market. It's just impossible. Statistically, it's impossible. I have a slide on that next. But if you want to think about this, you don't know when the next 25% move up or the 25% move down is going to happen. You just don't. Nobody does. But you know definitively, with absolute certainty, which way the next 100% move is going to be. That's up. It's just a function of time. So that's a reality. So if you go to cash, of course, you don't know when the market's going to turn up. You don't get any dividends. You don't get any interest. You don't get reinvested dividends. And you lose all the way around. What I see most with people who want to be in cash and they act on it is 99% of the time, these are people that are questioning their decisions in what they've invested in, or they're questioning their financial plan. They're doubting it. Typically, it's just a reminder of how the plan works, but sometimes you can't reach that person, and they just want to be in cash. That's a happier place to be. If any of you were like that or feel that way, please, reach out to me. My job is to hold your hand, not hold your feet to the fire. So I'm not going to get too far into this. I was looking at it, it bores even me, but essentially there's a lot of studies that, and my favorite one was even institutional managers who were trying to jump in and jump out, underperform those institutional managers who don't. Here's the chart. If you can see on the left-hand side, if you were perfect, if you were like Lizzie and you were perfect, and you invested perfectly every single time, you have $40,000 and you put it to work for 20 years, you'll have $151,000. If you invest immediately, you get $40,000 and you say, Doug, you know what? Put it in the market. You have 135. Dollar cost averaging, you invest the same amount, like $3,400 a month every month. You have 134. If you're bad timing, if you have the worst luck in the world, and then if you stayed in cash, that's what you get. So why bother trying to time it? If you have a long enough time horizon, you'll do just fine. Now, there's a nuance to this. I talk to a lot of people about how I'm going to deploy money, but I have a different agenda. I have something else that I'm thinking about. But when you're thinking about trying to time in and out, that's the spirit of this slide. Okay. So I don't know if anybody's ever heard this line by Ben Franklin, but it's essentially about compounded interest. Money makes money, and the money that money makes more money. It's this ongoing compounding of reinvested dividends and interest. And if you understand the math behind compounding, you realize that, and this is a very important distinction, that the most important question is not how I can earn the highest returns. That's not important because you can't control that. What's important are what are the best returns that I can sustain for the longest period of time. That's a little bit more within your control. Investing new money, rebalancing, trying not to get rich quick, and having discipline. And over time, you stay invested, the odds are very much in your favor. And understand that if you've built an appropriately diversified portfolio that's rooted in a solid plan, and you understand your overall time horizon and tolerance for volatility, these market drops like we're seeing now, or in 20, or in 2015, or in 2008, or 2002, or whatever, they're a blip on your radar screen. So I wanted to talk about why is it that when I talk to you, I'm projecting calm, and why I want you to be calm, because everything we do with the investment policy, how we're managing the assets, is rooted in factors that we are in control of. So it's really 4 pillars. It's very simple. It's been like this for a very, very long time. And it's it's a way that you can really control the outcomes. And number one is segmenting your buckets of money by time. Bucket of money, for instance, is just a pool of assets that you're going to use in a certain time frame. So, for instance, I don't know if you're out there. One of my friends has a kid that's getting married, and it's in the next year, and there's an engagement party and a wedding and all sorts of other stuff going on, and there's a lot of capital being allocated for this. And there was a question last week: hey, should we put it to work? Should we buy these inflation bonds and so on and so forth? And with your bucket of money, the first bucket is for what you need now until a couple of years from now. And that's generally cash and your income. So we segment your money into buckets based on when you need it. The longest term bucket being that money that's invested in the stock market, growing, on which you are going to take a distribution, anywhere from 3 to 5%. You're not going to be taking out giant chunks of money. The outcome of that bucket is not to theoretically get 30% a year, because we can't control that. What we know is that with dividends and interest and some growth, you're going to be able to sustainably take out 3, 4, 5, 5.5% in perpetuity. Number two, to be blunt, don't be stupid. Don't lose money. Don't try to get rich quick. If you don't understand blockchain, don't mess with it. Don't lose money. We just don't want to lose any money, because it's interest and dividends and growth you will never get ever again. So we manage to that. And it's very simple for me. It's buying quality. I've had this discussion with a lot of you, and it's the inevitable phone call I get once every week or two. Should we buy Ethereum or some cannabis stock? And my response typically is, sure, if you want, but there's always another way to make money in a company that has great earnings. So why bother? Now, this is a big thing, and I have a slide, and this is something I'm a big believer in, and that is preventing large drawdowns by being diversified. If you look at the math of this, and this is very real, you take $100,000 investment, and it goes down 32%, like it did at COVID. You're going to have to get about 50% to be back where you were. But if you're down 10% or 15%, you only need about 11 or 17 and a half or 18 to get back to where you were. And in 2008, something that was, I guess, somewhat good fortune, late in 2007, I had seen something that really distressed me with the banks, and I, pulled out all of my money out of banks. I still had some stuff in preferred stock, but the bank stocks, the common stocks, I sold out. And I sat in cash for a while till I could figure out what was going on. And then it all hit the fan, and Bear Stearns went down, and then Lehman went down, and everybody started going down in flames. And a majority of the portfolios went down no more than about 20-22%. But the S&P, of course, went down 57% at its low in March of 2009. It took till the end of 2012 to come back up. We were right back where we were in 2011, because the market was bumpy. This is the same thing. If you look at this slide, essentially what this is, don't focus too much on the slide right now. Just hear what I'm saying is that you take $100,000 and you invest it into the S&P 500 just before the dot-com crash in 2000. Now, the other side, on the right-hand side, is a balanced portfolio, same 100,000, same time frame. And what happens is that you have a 50% move down, and then it comes back up, and then another 55% move down the next time. But on the right side, with the balanced portfolio, you have a 24% move down and a 28% move down. Now, if you're looking at what's in the middle, you see that portfolio coming way further up, right? It's coming up quicker. But how is it possible that at the end of the 20 years, you're still ahead in the balanced portfolio? It's the arithmetic of having large drawdowns. So you get half the up and half the down in a balanced portfolio, but you're still going to get all the way up, because you don't have to overcome these massive drawdowns. And And, once again, that's a very important part of the, of the investment policy. And of course, in the spirit of being in control of things, I'm much more interested in being consistent reallocation, consistent rebalancing, adding money to the portfolio where you can. I can't focus in on the outcome of being correct all the time. I'm not going to spend all my time trying to figure out which, I don't know, which lithium stock is going to be the best one out of the 75 that are in an ETF. It's really not a good use of my time. We just want to have consistency, and that'll trump being right every single time. So the portfolios, for those of you who are new in the practice, we have three basic flavors. And, I do have a couple of models that are extremely conservative. Not too many people are in them, but these are really the headline portfolios. For the most part, 72% of the practice, the assets I manage are in the moderate model. But I took a random sample of 3 client portfolios in each one of these. And that's where I came up with the rate of return. Sometimes people have different investments that are in there because they brought them in, so it affects the rate of return, but not by much because the models are essentially the same for everyone. So the conservative model, and you know who you are, has about 57% in stock. The rest is in alternative investments, bonds, cash. So that portfolio year to date is down about 8.9%. The S&P, as of yesterday, was down 17.8%. The thing that's a bit jarring is the aggregate bond index is down 9.5% year to date. Now, the reason it's jarring is that you expect bonds to be that sort of shock absorber in the portfolio. And especially in this particular model, there's a lot of bonds in there. And in reality, if you look at, what's going on here, you see that this risk of 0.53, that essentially tells you it's about half the risk of the S&P 500. So it's down about 50% of the S&P 500. In reality, this portfolio really should be down about 7%. But this is very, very important. The spirit of this conversation is that I need to be able to say to every client, to every one of you at any point in time, based on what the S&P does, or whatever, based on what the NASDAQ does, based on what the stock market does, if it goes up 20 or it goes down 50, this is what you will do. I know within 3 or 4 percentage points what the models will do at every time. And then I say, Lizzie, are you okay with that? Or is that going to be too upsetting? And we have a heart-to-heart about it. And that's how we choose the model. It doesn't mean we can't then change the model. I had a conversation with a client last week who is in this particular model. And the beauty of this model is that you have a lot of dry powder to buy stock. And she was very interested in making sure that when the market, quote unquote, bottoms, we buy stock. Now, I can't tell when the market's going to bottom, but what I can do is as the market's dropping, I am buying stock in this model. For those of you who actually follow along in the portal and see your transactions, you've been seeing what I've been up to since November. I've been buying consistently on the way down. So the other big change that I will say is that underneath the returns, there's dividends and interest. I want positive cash flow in these investments. So what I've done is in every model, I've bought instruments that pay a much higher rate of dividend and interest. For the most part, it's dividends on stocks. So as of January of 22, this particular model was a 2.3% dividend yield. All that means is that if you have $100,000, it pays you $2,300 a year in interest, better than bank interest. And I've taken it up to 3.75 as of, last week with the last change I made. So I want positive cash flow. If we're going to be in a flat to a down market, I want a paycheck coming in here. And of course, these dividends are buying more shares of stock at lower points. So moderate, this is a majority of you. Usually this model is closer to 71, 72% in stock. It's off a little bit. I went to some cash late in the year when the market was at a high. I was doing some tax loss selling and I in the non-IRA accounts, and I went to cash, and As the saying goes, sometimes it's better to be lucky than good. Just around December, there was a lot of volatility, and I thought better of pushing a lot of money back in, and you saw the beginnings of the tech selling off, and then the tensions in Russia or the Ukraine started escalating, and then they invaded, and it was a good opportunity for me to slowly deploy money. And I never got all the way back in with stock. I started buying commodities and other things, given what's going on in the world. But same story. The sample client portfolio is year to date down 11.8. The S&P is down 17.8. The risk in this model is 40% less than the S&P 500. It's usually a little higher, but I have a lot of defense in the portfolio right now. I have a lot of options and things like that are protecting the downside. So the risk is lower. So the dividend was 1.9. It's now 2.7. So some of you with very large portfolios, that's a significant increase in income. And even in a smaller portfolio, it's a significant percentage increase in income. So it keeps a floor underneath stock. And I like that in a time like this. So the aggressive, same story, same theory. This is a 14% down against basically 18% down in the S&P. The risk in this is 24% less than the S&P. Now, this model is a lot more supercharged. So this is off a little bit more, probably about 2 percentage points than I expected. And the exact reason for that is the culprits, this usual culprits: Amazon, Apple, Microsoft. I don't own any Netflix. I don't own any Target. I don't own any Tesla, or else it would have been a lot worse. But when you have Amazon that's down 50%, this is what you get. But it's the same theory. I've been buying into the weakness. And this is one of these conversations that I want to have with any one of you who want to have it personally, because it is very personal. Each portfolio will act a little bit differently depending on the timing of it and what came in with it. Okay, so I'm not going to get too far into this. I guess I'll address, this is addressing what's happening in the portfolios and what I'm thinking about. I will say that I have no direct Russia play. I had about 7 percentage points of the entire portfolio in 2 mutual funds. Each one of those mutual funds had about 6.5% allocated to Russia, which got written down to 0. So essentially 6% of 7% got wiped out. That's about 0.42% of the portfolio. That was our Russia exposure. It happens. I didn't want to invest in Russia or China for that matter. I'm not particularly interested in any country where the rule of law is an option. So I stayed away from that. I've been out of China for about a year. We're using commodities. I've never really used them before. We made some money in a commodities trade. We were in and out in about a month. I found a different way to own it in a couple of different mutual funds. We're using some currency futures where I'm able to short the treasury, and I can be long the US dollar as interest rates go up. So I'm trying to use baseball vernacular, trying to manufacture some runs. I've reduced the big change that I made beginning in January, actually. I don't know if this client is on the call. There was a client who came in who had a lot of bonds that were very long duration, like going out to like 2047. And the math on a bond, by the way, just so you know, is that every point in interest rates go up, you multiply it times the duration. So if you have a 20-year bond, you could have a bond position that immediately goes down 20%. And then the problem is, what are you supposed to do? You sell it and then hope whatever you buy gets 20%, or you just wait it out for it to mature. It'll be money good. You'll get your money back. So I reduced bond exposure across everything by about 80%. In favor of some of these alternatives, I've been buying a lot more stock that has high dividends and some other instruments to increase income in the portfolios. Because to me, if bonds are going to drop, I'd rather be in stock that pays a higher interest, that has a lower volatility. It's the same thing, but at least I have a positive cash flow. And the volatility in the portfolios it's not any different. So, um, clearly I've been cutting technology. I'm about to cut that some more to buy some more value stuff I really don't love buying, but I think it's going to be where we need to be for the next year or so, especially if we go into a recession. And the thing about a recession is that you can figure it's coming, but it's like kindling in a forest. You don't actually know what started the forest fire. You know that there's a high likelihood of it happening. I think we can all say we're nearing the end of the cycle, and there's probably going to be a recession sometime between 6 months and 18 months from now. And once we're in, we don't even know when it's going to happen. It sort of creeps up on you. And I feel as though if we're going to have equity, I want to have equity that's cash flow positive. So, we were talking about your plan. I want you to remember what your plan is about. And I want you to remember what we do to help you with your plan. Your plan is about you being able to sleep at night. It's about your peace of mind. That's the why of your planning. So you can implement what's really important to you and continue to do that for your entire life. And our job with you is to help you implement or design first and then implement the well thought out plan. And your goal is very simple. You want your money to outlast you, not the other way around. That's our work. Now, the asset management that we do, it's fun to talk about. I'll talk about it all day long, but it's not the most important thing. This is the most important thing, helping you stay on track with your plan. The asset management really is the free toaster of the industry. Our core competency is what you see here on the screen. It's guidance and expertise, and all expertise is, by the way, is knowledge that we've gained, plus mistakes that we've made, and that turns into expertise or wisdom. Record keeping, helping you keep track of what's going on, taxes, performance. You have these old claims that come in on a position you had 25 years ago. The biggest thing is helping you not make a mistake just at the wrong time, helping assuage any concern you have to sell out and go to cash or to do something else that you may regret. And as I said, it's the successful implementation of your well thought out plan. So what we believe is your portfolio is first. The plan is first, not your portfolio. You're supposed to be doing planning, not predicting. And our job, why we were put here, is not to chase the S&P around in circles. Our job is to help you avoid making the wrong decisions just at the wrong time, like I said in the last slide. And I want to seek volatility. I want to accept volatility and be prepared when something bad does happen. Some of you have been with me for a very long time and have seen how I roll when that happens. And it's going to serve us much better than this fallacy that we can protect you from anything bad happening. Bad things are going to happen. We just want to help you be prepared for it. Now, your constants. These are the things that you need to remember and that I really hope you take away from today. Number one, I want you to stay the course. Now, I was going back and forth on whether I wanted to put this bullet in there, because what it really sounds like is, everybody loves to be told to calm down when they're upset or, don't get angry. But I'm telling you, stay the course. I'm always here to talk and go through it with you. But if you are compelled to make a change, if you're just upset and you feel like this time is different, who am I to disagree with you? You call me and we'll talk it through. I really want you to be able to define your why of your plan in a sentence or two. You're sitting at Thanksgiving or you're sitting there at Memorial Day with a drink telling everybody about your fantastic advisor. You want to be able to talk about what your plan is. Are you going to remember these 20 stupid slides and all this nonsense I said? Figure out what your plan is. We've talked about it a lot. And unless your plan changes, don't change your investments. There's no risk there is absolutely no risk of loss of principal in a properly designed portfolio. As I said, inflation and time horizon is your risk, and you want to avoid regret. And regret's going to come from a fear-driven exit of your positions. And when they resume the advance, and you have that tinge, that awful feeling, that's what I want to help you avoid, because they always do. So I'm grateful for every one of you. I can't see you right now. I saw a bunch of you log in. As you know, you're my family, and I'm grateful. You're all with me, and we're in this together. And it's a privilege. I still love my job. I'm going to continue to love my job until the bitter end. And I'm here for you when and however you need. I'm going to stop sharing now. Lizzie will help take some questions if anybody wants. So Lizzie, I see some chat things, and if you want to do the little hand raise thing, you're free to speak up.
Yeah, so we have a couple of questions in the chat. First, I'll start off with our first one. What is the impact of the bond market not behaving as it usually does on the models during downtimes?
Okay, so the bond market's not behaving was the question, and what's the impact on the models? So number one, there was not a huge impact on our models because I was out of it pretty early on, especially in the aggressive and moderate models. The impact on the conservative portfolios, I don't know if any of you are on here. I'm looking around. I don't see any of you. That had an impact that I wasn't thrilled about, but it wasn't unexpected because the bonds are short duration. Nothing's longer than a 5-year duration, and I don't own any junk bonds. So in those portfolios, these clients cannot withstand any type of volatility. They don't want to see it or hear about it, and they need positive cash flow. So the effect, I think, in the moderate model was probably a couple of percentage points more drawdown than I thought. It's disconcerting, but on the other side of it, you can't be 100% right on the timing of a trade. So when I saw it, I got out. I moved out the last of the bonds that I wanted to move out about a month and a half ago. So I hope that's helpful.
Okay, and our next question. Looking at the long-term and sustainability, what is your feeling about the dividend/revenue-driven safe havens like Walmart, Apple, Amazon, etc., being able to sustain their current dividend payments? Is there any likelihood dividends can be substantially reduced?
Absolutely. Dividends can always be cut. One of the days I look forward to is when I hear Amazon in a conference call saying that they're going to pay a dividend, because they don't. That's what I want to see. But the day Amazon pays a dividend is the day Amazon turns into a different company, because they want to use their money for CapEx and spaceships and whatever else they're investing in. And I think that there's always a chance of a dividend cut. That's why I'm very careful about my position sizes. If the largest you'll ever see me get in a single stock position, no matter how confident I am, is 2.5%, 3%, and that's after appreciation. In the model, even in the aggressive model, the stocks that I'm most confident in, which are Microsoft, Apple, Amazon, Google, and one or two others, are only 2%. So any dividend cut, even if it were to zero, make no impact on the portfolio. If you have a 3% dividend that gets cut to zero, it doesn't really matter on a 2% position because it's 0.06 of a point. So the only outsized positions you will ever see me take are in very, very large ETFs or mutual funds, and those positions, there are 100, 150 positions in there. So the sustainability of the portfolio is never dependent on any one position. And I will freely admit to whoever asked that a question and everybody else on this call, it's the one time in my career that I had regret. I got chased out of a position. So it was after all the banks were crashing. And I wanted to buy what I thought were trust preferred stocks, but trust preferreds are higher in the food chain. So I saw the CEO of Citi bought his preferreds in the middle of the storm at 17, and the par value of these things are 25, and he bought it at 17. So I thought I was really smart. I waited like a week. I bought it at 13. And of course, the dividend yield on that, the interest was like 14%. I thought I was a genius. But I had a 12% position in these things. So you could see how this story ends. So a week later, they have that vote on TARP. And if any of you remember, TARP didn't pass the first time. And I've never been so scared in my life. Like I think we were a day away from money not coming out of bank machines. And there was this terrible feeling that I had, and a lot of people had, that banks were going to be nationalized. And when banks are nationalized, everything goes to zero. So I couldn't call clients and say, listen, the stock was worth 9 and I wrote it to 0. So I sold it. A week and a half later, they were all back up at 17 or 18. And that stung. That hurt a lot. It taught me a lot about position sizes. I think that was the biggest lesson I took away from it. It taught me a lot about position sizes. And I think it was the day that I really decided I was much more comfortable with stock than bonds, because stocks are rooted in some type of reality, of earnings and cash flow and everything like that. Bonds are just a promise to pay. So I hope that was helpful. Anybody else, Liz?
I don't see any in the chat. If you want to, speak your question, that would be awesome as well. You can send more in the chat as well.
Okay. I don't see any little hands, yellow hands. Is anybody doing laundry today? Somebody was doing laundry on one of our calls last year. Holding his laundry. That was fun. I see a Mets hat.
Doing Pilates.
Okay. All right. So each and every one of you knows where to find me. I love seeing people sit on the couch together like two lovebirds. That's always fun. I'm looking right at you, Linda and Todd. And so you're all free to go. Please reach out to me tomorrow or the next day, and I'm always available to help out. And we'll start kind of contacting you again over the next several weeks about scheduling calls and reviews. And I wish everybody a great week, and thank you so much for jumping on the call at the end of the day. Okay.
Thank you.
Thank you very much. Bye, everyone.
Thank you very much.
Bye-bye. Thank you.
Good job, Doug.
Happy hour.